Joseph, welcome on this stage.
Yeah,
So we are going to take sustainable investments from a broader perspective. We're going to discuss the dual materiality, but before we dive into our topic, could you explain us what you mean by dual materiality as opposed to the concept of single materiality that is most commonly used in the financial markets?
absolutely. Thank you. It's a question of perspective. Are we looking at things inside out or outside in? Let's take the example of a gold mining company. We could say that water and natural capital is very important when looking at a gold mining company, but are we looking at it in terms of how the outside world, such as water scarcity, affects the profitability of the operations, because management will need to put in the right equipment to be more efficient with the scarce water to maintain profitability? Or are we looking at things in terms of inside out, which is more known as impact, and how the operations of a company affect the outside world and how much mercury goes into the water before it gets pumped into the river and pollutes the few villages down the road? Now, that might result in them having their license revoked in 5 years' time. And regulations is the biggest change happening right now, is that the global regulations, it's gone very far, but there's regulations that affect perception, but there's regulations that affect reality. And having the license revoked is getting priced in. So we're looking at things in terms of trading in the noise and that kind of volatility, or we're looking at things in terms of as fundamental long-term investors and the fat tail risk we take. It's also a question of, if we are looking at impact, what are the transmission mechanisms that lead to such change? And that's also a question of perspective.
How would you define these transmission mechanisms you're talking about, and how do they fit into the asset allocation?
Well, every asset class or even fund strategy has different transmission mechanisms at their disposal. And all portfolio management is just a question of allocation of risks. And how are you mobilizing those transmission mechanisms if you want to actually have an impact? So it starts off with understanding the client and understanding the actual purpose of the capital and the extent to which it wants to just be aligned to an impact or cause and catalyze one, and how far early stage we're prepared to take that risk. So we can say we're impactful in primary markets, yes, but many times aligned to it. We can have cost of capital and engagement, but it's not going to go as far as if we're looking at early stage VC with first-time funds that are actually solving a problem no one's tackled before, because regulations are giving that financial catalyst for it. How do we look at infrastructure and mobilize the fund strategy? How do we look at other building blocks? Litigation finance, very profitable given the ability that regulations are giving us to mobilize capital in a way that is highly excess returns than anything else. Every asset class is donned with various levers of influence that are at the disposal of the allocate. So whilst ESG is ex post, it's part of the due diligence, it's more data to make better decisions, and I'd say just part of doing our job generally. Impact and dual materiality is ex ante, and that starts at the very beginning of a strategic asset allocation or design of a fund or of an asset class allocation, and what the expectations of the catalysts we want to have on the end results are and how to mobilize it. And regulations are providing a very exciting opportunity to do that.
In a recent past, we have seen quite growing skepticism around ESG investing. How would you actually explain this cooling interest in ESG?
It's very welcome, healthy, and necessary. I think I wouldn't call it an ESG backlash. I'd call it a backlash against oversimplification. If we are relying on outside labels to carry on without doing our work of understanding how returns are being generated and where risks are being deployed, it does require a cool down and a forcing of the system to take on the nuance required to look under the hood. It is a bit more complex and necessary. So whether it's regulations or whether it's how things are being curated in the narrative, there's managing perception. So whether it's regulations focused on reporting or how things are being positioned versus regulations or products which are focused on reality. And regulations such as the carbon border adjustment mechanism, the supply chain due diligence across globally, they're changing operating models, that are changing the requirements for unit economics to completely change. That is accelerating, is becoming mainstream, is the #1 return generation alpha that I've seen in a long time. I'd even say that how you not only determine asset allocation, but even fund selection or even fund design, as we're trying to achieve in the plastic transition. How do you tackle a problem where unit economics didn't work previously, but all actors across a value chain are all looking at a different way to mobilize financial capital to do what finance was always designed to do, which is finance and activity, not just scout the returns.
Thank you, Joseph. Thank you very much. And I think on this plastic transition, there will be more to hear from you in the next minutes. Thank you for joining us today.
Thank you.